What if I told you, the biggest threat to the US economy right now is not AI, not inflation, and not even China. It's something so boring, almost nobody is paying attention. But here's the scary part. It's already affecting your mortgage, your investments, and the cost of your life. And it doesn't even start in America. It starts in Japan. Now I know what you're thinking. Why should I care about Japan? Fair question. Because for the last 30 years, Japan has quietly been the financial backbone of the world. And that backbone, it's starting to crack. To understand this, we need to go back. Early 1990s. Japan's economy crashes, real estate collapses, stocks collapse, and the country enters what's called the lost decades. No growth. No inflation. No wage increases. It was like the entire economy hit pause, and nobody could find the remote. So the Bank of Japan did the only thing they could. They dropped interest rates to zero, then below zero, and when that still didn't work, they did something extreme. We don't care what the market wants, we're keeping interest rates low, forever. So for decades, Japanese bonds paid almost nothing, 0%. You've got millions, maybe billions. And your own country is giving you zero return. So what do? You leave. Let me simplify this with a story. Meet Bob. Bob borrows money in Japan, at almost 0% interest. Then he converts that money into US dollars, and buys US government bonds paying 4%. Easy money. Right? That difference, that's profit. This strategy became known as the yen carry trade. People like Bob didn't just buy bonds. They bought US stocks, real estate, tech companies, emerging markets. Basically, if it made money, they bought it. Global markets were running on cheap Japanese money. Like Wi-Fi you didn't even know you were connected to. But every system has a weakness. And this one depended on just one assumption. Japan would keep rates near zero forever. That assumption broke. Japan started raising interest rates, for the first time in 17 years. And suddenly, everything changed. Cause when rates go up in Japan, borrowing gets expensive, profits shrink, the easy money disappears, and investors start pulling money out of global markets and sending it back home. Now here's why this matters to you. When that money leaves, stocks get shaky, markets panic, and interest rates stay high. Most people think the Federal Reserve controls everything, but that's not true. They control short-term rates, but long-term rates, those depend on supply and demand. The US is printing trillions in debt every year. Someone has to buy it. For decades, Japan was one of the biggest buyers. But what if they stop? What if they pull back? Then interest rates have to rise to attract new buyers. And when that happens, your mortgage stays expensive, housing stays unaffordable, businesses borrow less, growth slows down, and suddenly, the entire economy feels tight. Just a bond market story. This is an everything story. Because for 30 years, the world depended on one simple thing, cheap money from Japan. And now, that era is ending. And that's why the real risks in the market aren't the loud ones you see on the news. They're the quiet ones, hiding in plain sight. If you want to understand what's actually happening in the economy, not just headlines, hit subscribe, because I'll break down what others ignore.